Matt Garland here, NMLS number 58700, but better known as MG the Mortgage Guy. There's all these different types of FICOs out there, and I see it confuses everybody. No one knows what the hell they mean. So I had to bring in a credit expert, Sean DeMond. What the hell is all these FICOs? Can you break it down for us, please?
Under the FICO umbrella, there are different industry-specific models of your credit scores. For example, if you are trying to get a car, there's a such thing called your auto score. If you're going to get a credit card or a loan, there's something called a bank card score. And the differences between those scores are just they're industry-specific. They rate things on a different scale that are more tailored to the lender in that industry. So specifically with mortgage scores, I would say the FICO model that pretty much encompasses all of them. It's the least lenient version of our credit scores, which is why most people believe that the mortgage industry still seeks out the FICO 2, 4, and 5, being that it's such an outdated model of our current scores, because we're on FICO 10 right now. And mortgage scores are FICOs 2, 4, and 5, which was in like 96. So
Wow.
they still are on that older model of score because it's literally the most hard on consumers because of things like they do not specify different collection types. So a $2 medical collection affects your mortgage scores the same way as a $5,000 repossession collection. They all are on the same categories. Collections are all weighed the same in mortgage scores.
So the mortgage scores is like
Yes.
the teacher that you hate the most because you know they're going to grade your paperwork the hardest.
So that's definitely a way to explain it. That's essentially what mortgage scores is in comparison to the different other types of FICO scores.
So that's why when we look at our credit scores, like if you look at one of these apps on your phone, your scores might be 750, but then I see people and then they have a 620. Like, why is that?
The average person's FICO 8 score is typically 60 to 80 points higher than their mortgage scores. And that's because of people just not knowing that it behaves differently than the scores that they're used to dealing with. Because outside of getting a mortgage, we don't deal with FICO 2, 4, and 5 ever until you get a mortgage. You can get a credit card, you can get a bank, multiple of the two, and you will never probably have any knowledge of what your FICO 2, 4, and 5 scores are until you are seeking a mortgage. So it just behaves differently because it's so outdated. Most people have very high limit credit cards nowadays, so they're not really pressed or stressed about their utilization. If let's just say they have like a $30,000 credit limit, most people, that is enough to keep their utilization in check pretty much every month. But when it comes to mortgage scores, that $30,000 credit card is not even counted in the calculation because it ignores any cards over about a $31,000 limit. Just because back in the day, it was not usual for people to have trade lines that large. Another really big difference in your mortgage scores is the fact that anything over 48%, it shows as a maxed out card towards your mortgage score. Even if your overall utilization is under 20%, under 10%, if you have one individual card with over 48%, you're getting what we call a max out penalty, and that decreases your mortgage score.
So in layman terms, if the card gives me a limit of 10,000, and I owe 5,000, the mortgage scores are reading it as if it's maxed out, which will lower my credit scores.
You're getting a max out penalty, which will absolutely lower your mortgage scores. And most people won't realize that because their FICO 8 score is probably not affected by that. So they don't realize that that's like one of the biggest differences between your mortgage score and like your FICO 8 score, which is the one that we're used to dealing with, the one that you see when you log into your apps, the one that is most widely used by 90% of lenders. Let me do another one because most American Express cards right now are charge cards. And a charge card means that it does not have a preset limit. So when it comes to your credit report, it does not report a utilization or a limit for any charge card. Charge cards specifically for mortgage scores, even if you have $1, you can literally buy a bag of chips and not pay it off. That card is going to read as maxed out because it'll automatically double the balance as the limit in your mortgage scores, just because it was not common to have a credit card without a limit in 96. It was unheard of. So there was no sort of variation of how they calculate that. They didn't start getting calculated until FICO 8. So that's another big one. People will have $10 on their, let's say, American Express Gold card, and they're not knowing that that $10 card is showing a maxed out penalty on your mortgage scores.
What are the tips that you can give us to get ourselves mortgage ready while we're in that process of home ownership?
So 3 very specific things that I recommend to everyone that is seeking a mortgage is, number 1, make sure that every single credit card that you have is under 10%. If you can get it between 1% and 3%, that'll pretty much maximize your mortgage score. So I actually recommend that prior to getting a pre-approval, like right before you get your pre-approval, take your utilization on each individual card between 1% and 3%. Any charge card that you have to zero out that balance. put that card in a drawer until after you close, because any activity on that card is going to affect your mortgage score. Another tip I would give, if you have at least 3 credit cards, do something called the AZO method, which stands for all zero except one. This is going to boost your mortgage score, and it literally can boost it in the matter of like 3 to 4 weeks. And what you do is, if you have at least 3 credit cards, you zero out all of your balances on all of your credit cards except one. The one credit card that you do have a balance on, put about $10 to $20 on there and allow it to report past the statement date. And what will happen is it'll boost your mortgage scores because you're not utilizing any of your other credit cards and you only have a balance on one. So you are showing usage, but you are showing that 90% of your credit cards are fully available, which increases your mortgage score. So it's called the AZO method, all zero except one. And that only will be effective if you have at least 3 credit cards. So one other thing that I recommend when it comes to your mortgage scores is any loan that you have, if you pay off at least 91% of that loan and have a remaining balance of 9% or lower, you're going to get incentivized on your mortgage scores for any loans that has a balance under 9% of what's owed. And you do this by just applying a principal only payment. Call your bank or whatever creditor that you have and see if you can apply a principal only payment and report a balance of under 9%, and that'll also boost your mortgage score.
Ladies and gentlemen, Shonda Martin is the GOAT of credit. Make sure y'all subscribe to her channel, tap in with her. All her information will be in the description of this video. Thank you again for coming on the channel and blessing us with these credit hacks. This is Matt Garland, NMLS number 58700, better known as MG the Mortgage Guy. Peace.